Hello and welcome. In this presentation, we will be exploring the essential topic of capital budgeting with a specific focus on one of the most powerful tools in finance and accounting, the net present value method. We'll learn how managers can use this tool to make profitable long-term investment decisions. Our agenda today provides a clear path to understanding these concepts. We'll begin by defining what capital budgeting is and the types of decisions it involves. We will establish the golden rule for these decisions, why our focus must be on cash flow, not accounting income. We will then cover the core concept that drives this entire analysis, the time value of money. Next, we'll introduce the net present value, or NPV, method as our primary decision tool. We'll then apply it first in a simple case study with Harper Company and then in a more comprehensive case with Swinyard Corporation. Finally, we'll discuss how to interpret the results of an NPV analysis to understand what it really tells us about a project's value. So let's start with a definition. A capital budgeting decision is any decision that requires a cash outlay now in order to earn returns over a multi-year time horizon. These are the major long-term decisions that shape a company's future. Typical decisions include cost reduction projects, such as buying new equipment, expansion decisions, like building a new factory, equipment selection decisions, and lease versus buy decisions. These decisions generally fall into two broad categories. The first are screening decisions, where we ask, does this project meet our minimum standard? For example, does it provide at least a 20% return? The second are preference decisions, where we have several acceptable alternatives and we must choose which one is best. A golden rule in capital budgeting is that we must focus on cash flows, not accounting income. Methods like NPV analyze the timing and amount of cash moving in and out of the company. Typical cash outflows include the initial investment in equipment and other assets, any related installation costs, and any investment in working capital such as cash, accounts receivable, and inventory that's needed to support a new project. Typical cash inflows include any increased revenues or cost reductions the project generates, the salvage value of equipment when the project ends, and importantly, the release of that working capital at the end of the project's life. The entire basis for our analysis rests on a foundational concept, the time value of money. This concept simply recognizes that a dollar you receive today is worth more than a dollar you receive a year from now. And why is that? Because the dollar you have today can be invested to earn a return, so you'll have more than a dollar in the future. Some simple capital budgeting methods, like the payback period, completely ignore the time value of money. The net present value method is a superior tool precisely because it uses a technique called discounting cash flows to translate all future cash flows back to their value in today's dollars, their present value. This allows us to compare cash flows that occur at different points in time on a true apples-to-apples basis. Let's officially introduce our primary tool. The net present value, or NPV, method works by comparing the present value of a project's cash inflows to the present value of its cash outflows. The difference between these two is the project's net present value. The decision rule for NPV is very straightforward. If the NPV is positive, the project is acceptable because its return is greater than the company's required rate of return. If the NPV is zero, the project is also acceptable because its return is equal to the required rate. However, if the NPV is negative, the project is not acceptable because its return is less than the required rate of return. Let's walk through our first case study with Harper Company, which is considering buying a new machine. The initial investment, an outflow, is $50,000 today. The project will generate inflows in the form of annual cost savings of $18,000 per year for 5 years, and it will have a salvage value of $5,000 at the end of the fifth year. The company's required rate of return, which we will use as our discount rate, is 18%. The analysis involves discounting all of those future cash inflows back to their present value and comparing that sum to the initial investment. As you can see in the table, we lay out the cash flows for each year, apply the appropriate 18% discount factor, and calculate the present value of each cash flow. Summing this up gives us a final net present value of $8,471. So, what does that positive NPV of $8,471 really mean? A positive NPV tells us that the project is doing much more than just paying for itself. The net present value method automatically provides for a return of the original investment. Whenever a project has a positive NPV, it means that the project will generate enough cash to do two things. First, recover the original investment, like the $3,170 for the Carver Hospital X-ray attachment. And second, it will provide a return on that investment that is equal to the company's minimum required rate of return. The positive NPV itself represents the excess cash flow beyond those 2 points, meaning the project will increase the company's value. Now, let's look at a more comprehensive example. Swinyard Corporation is analyzing a special 5-year licensing arrangement that involves multiple complex types of cash flows. The cash flows include initial outflows in year 0 for the equipment purchase and an investment in working capital. It has an annual operating cash flow for years 1 through 5, and an additional interim outflow in year 4 for an equipment overhaul. Finally, in the terminal year, year 5, it has inflows from the salvage value of the equipment and, importantly, the release of the working capital that was invested at the start. As you can see from the analysis, after all of these cash flows are laid out and discounted at the company's 14% rate, the project has a positive net present value of $31,410. Therefore, the project is acceptable. Let's summarize our key takeaways. Capital budgeting is the process for making crucial long-term investment decisions. When performing these analyses, it is critical to always focus on cash flows, not on accounting income. The net present value method is a powerful tool because it properly incorporates the time value of money, making all cash flows comparable regardless of when they occur. The NPV decision rule is simple. A positive or zero NPV means the project meets or exceeds the company's minimum required rate of return and should be accepted. Ultimately, a positive NPV project is one that will increase the value of the company by generating returns in excess of its cost of capital.